If you are starting a company in Japan, one of your first decisions is whether to establish a Kabushiki Kaisha or KK or a Godo Kaisha or GK. If you are setting up a KK in Japan, we can help with company setup, business manager visa planning, corporate bank account preparation, and more. Contact us to speak with one of our experts. A KK is Japan's joint stock company structure. It is widely recognized by Japanese banks, investors, customers, suppliers, and large corporations, but it is also more formal and more expensive to establish than a GK. A GK is usually cheaper, simpler, and more flexible. The right choice depends on how the company will be owned, managed, and funded, not on which name sounds more prestigious. In this video, we will explain what a KK is, how it differs from a GK, who should use one, how incorporation works, what it costs, and what happens after registration. We will also explain how the company structure relates to the updated business manager visa requirements. This is general information, not legal, tax, accounting, or immigration advice. Please contact us to speak with one of our experts before transferring capital, signing a lease, or filing incorporation documents. What is a Kabushiki Kaisha? A Kabushiki Kaisha is a company owned through shares. Shareholders own the company, while directors manage its operations. Shareholders generally have limited liability up to the amount they invested. A KK does not need to be large. A private KK may have one shareholder and one director, and the founder may hold both roles. It does not automatically require a board, several executives, or an auditor. A foreign individual or overseas company can own 100% of a KK. A Japanese shareholder, partner, or co-founder is not generally required. The representative director also does not generally need to live in Japan. However, a company managed entirely from overseas may face practical difficulties with office leases, bank accounts, identity checks, official mail, local contracts, staffing, and immigration applications. Legal permission does not guarantee operational convenience. Why choose a KK? The main reason is its share structure. A KK can issue shares to founders and outside investors. Ownership percentages, voting rights, transfers, new investment, employee stock options, and future financing can all be organized through shares. This makes a KK useful for startups seeking equity investment, companies with several founders, overseas businesses establishing Japanese subsidiaries, joint ventures, or companies expecting acquisitions or ownership changes. The second reason is familiarity. Japanese corporations, institutional investors, banks, landlords, lawyers, and accountants understand the KK structure well. Some traditional clients may prefer dealing with a KK, especially in relationship-driven industries or corporate procurement. But a KK does not create credibility by itself. A newly formed company with little capital, no customers, no website, and no operating evidence is still a newly formed company. Banks, investors, and clients will examine the substance of the business. KK versus GK both, a KK and a GK, are separate legal entities. Both can have one owner, hire employees, sign contracts, rent offices, own assets, and limit the owner's liability. The main differences are ownership, governance, fundraising flexibility, and cost. In a KK, shareholders own the company through shares, and directors manage it. This structure is better suited to conventional equity investment and future ownership transfers. In a GK, the owners are called members and usually have a more direct role in management. The articles can provide more flexibility in decision-making and profit distribution. A GK does not issue shares and is usually less attractive to venture capital firms or institutional investors. A KK requires notarized Articles of Incorporation, more formal corporate procedures, and a higher minimum registration tax. A GK does not require notarization and is generally cheaper and easier to administer. For a consultancy, agency, design studio, e-commerce business, software service, or closely held local company, a GK may be sufficient. A KK becomes more useful when outside investors, several shareholders, corporate partnerships, or future ownership changes are expected. We are only giving you the short comparison here. For a full breakdown of the Godo Kaisha structure, setup process, documents, and costs, watch our separate GK video. It is linked on screen and in the description. Does a KK improve a business manager visa application? No. Immigration does not approve an application simply because the company is a KK. Under the revised business manager rules, introduced on October 16, 2025, applicants generally need 30 million yen in capital or qualifying business assets, at least one eligible full-time employee, Japanese language ability at approximately JLPTN2 or CEFRB2, level held by either the applicant or a full-time employee, relevant management experience or an eligible graduate qualification, and a business plan reviewed by an eligible professional. These requirements apply whether the company is a KK or a GK. We can also help you plan the company setup, capital, premises, and business manager visa process. The legal minimum capital for incorporating either structure remains 1 yen, but that is only a corporate law minimum. It does not make a business credible, operational, bankable, or eligible for business manager status. Capital should reflect the company's real operating and immigration needs. The business manager application is separate from company registration, and the requirements changed substantially in October 2025. We have a full video explaining the updated capital, employee, Japanese language, office, experience, and business plan requirements. Watch that video before relying on old information about the visa. Who should consider a KK? A KK is worth considering when the company expects angel, venture capital, strategic or corporate investment. Several founders need clearly defined ownership and voting rights. An overseas company is establishing a Japanese subsidiary. The company expects shares to be transferred, sold, inherited, or issued later. Employee equity, acquisitions, or future financing rounds are likely. Or large Japanese clients or institutional partners strongly prefer a traditional stock company structure. AKK may be unnecessary when the business will remain founder-controlled, closely held, and unlikely to raise equity. In that situation, AGK may achieve the same commercial goal with lower costs and lighter administration. The KK incorporation process. First, define the company profile. Choose the company name, registered head office, business purposes, capital, shareholders, directors, share structure, fiscal year, and public notice method before drafting documents. The Japanese legal name must include Kabushiki Kaisha before or after the company name. Check not only the commercial registry, but also trademarks, domains, social media handles, and existing brands. The registered head office determines which authorities have jurisdiction. A residence, serviced office, shared office, or virtual office may sometimes be usable for company registration, but it may fail the requirements of a landlord, bank, license, or business manager application. Confirm that the address works for every intended purpose before signing a lease. The business purposes listed in the articles and registry should cover the company's real activities and reasonable expansion. Avoid wording that is either too narrow or an unfocused list of unrelated industries. Regulated activities such as recruitment, real estate, travel, construction, finance, transport, alcohol, or medical services may require precise wording and separate licenses. Choose a realistic capital amount. It should cover incorporation, rent, equipment, payroll, licenses, professional fees, marketing, and working capital. Increasing capital later is possible, but it requires additional corporate procedures and registration. The incorporator is the person or company establishing the KK and subscribing for its initial shares. If several people or companies invest at formation, the documents must clearly state their contributions, shares, and ownership rights. Most small private KKs restrict share transfers so that an owner cannot sell shares to an outsider without approval. The company should also authorize enough shares for expected future financing without creating unnecessary complexity. A simple private KK can usually operate with one director, who may also be the representative director. Do not create a large board merely for appearance. Every formal role creates additional documentation and compliance work, preparing and notarizing the Articles of Incorporation. Next, prepare and notarize the Articles of Incorporation. The articles contain the company's foundational rules, including its name, purposes, head office, capital contribution, incorporator, authorized shares, transfer restrictions, governance, and public notice method. A Japanese notary must certify the original articles of a KK. For capital below 1 million yen, the standard fee is 30,000 yen. That fee can fall to 15,000 yen, but only when all of the qualifying conditions are met. All incorporators must be individuals. There must be no more than 3 incorporators. They must subscribe for all of the initial shares, and the company must not establish a board of directors. For capital of 1 million yen to below 3 million yen, the fee is 40,000 yen. For capital of 3 million yen or more, the fee is 50,000 yen. Certified copies usually add about 2,000 yen, depending on the length of the document. Paper articles normally require a 40,000 yen revenue stamp, while properly prepared electronic articles avoid that stamp duty. Foreign incorporators or shareholders may also need identity documents, corporate records, affidavits, translations, notarization or authentication, paying the initial capital. After notarization, pay the initial capital. Because the company does not yet exist, the capital is normally paid into an eligible account belonging to an incorporator or another permitted person. The registration filing must include clear evidence of the account holder, transaction date, and amount. Foreign founders should plan this carefully. International transfers, exchange rates, incomplete sender information, translations, and multiple contributors can complicate the evidence. For immigration purposes, keep records showing not only that the money was paid, but also where it originally came from. The incorporator then appoints the initial directors and representative director. Foreign directors may need notarized signature affidavits or equivalent documents. Names and addresses must be consistent across passports, affidavits, and translations, articles, and applications. Filing the incorporation registration. Finally, file the incorporation registration with the Legal Affairs Bureau responsible for the head office. A typical filing includes the registration application, notarized articles, proof of capital payment, director appointments, acceptance documents, identity or signature certificates, corporate resolutions, and details of the registered matters. The registration and license tax is 0.7% of stated capital, with a minimum of 150,000 yen for a KK. The company legally comes into existence when the registration filing becomes effective. A straightforward case may move quickly, but foreign-owned companies often take longer because documents must be collected, authenticated, translated, reviewed, and corrected. What happens after registration? Registration creates the legal entity, but it does not make the business fully operational. The company must obtain registry certificates and, where relevant, a seal impression certificate. It will also receive a 13-digit corporate number. Tax notifications must then be filed with the national, prefectural, and municipal authorities. Depending on the company, these may include establishment notices, blue form tax filing, payroll office notifications, and withholding tax documents. If the company pays directors or employees, payroll withholding, social insurance, labor insurance, and employment insurance may apply. Director compensation should be planned carefully because changing it during the fiscal year can affect tax deductibility. Any required business licenses must be obtained separately. Listing an activity in the articles does not authorize the company to conduct it. Foreign investment reporting may also apply under the Foreign Exchange and Foreign Trade Act, particularly in regulated industries. Some investments require notification before incorporation or share acquisition. Opening the corporate bank account. A corporate bank account is not automatic. The bank will examine ownership, beneficial control, capital sources, business activities, customers, office arrangements, licenses, and evidence that the company is genuine. Before applying, prepare the registry certificate, articles, identification documents, business plan, Japanese language company description, website, lease contracts, invoices, purchase orders, customer evidence, licenses, and capital records. The KK structure may be familiar to a bank, but it does not guarantee approval. If an application is rejected, strengthen the weak parts of the package before applying elsewhere. We are only covering the bank account briefly in this video. For a detailed explanation of what Japanese banks examine, which documents to prepare, and why foreign-owned companies are often rejected, watch our separate video on opening a corporate bank account in Japan. How much does a KK cost? The main government cost is the registration and license tax, with a minimum of 150,000 yen. Additional costs may include notarial fees, the 40,000 yen stamp for paper articles, certified copies, translations, authentication, company seals, registry certificates, and professional fees. Foreign-owned or complex companies usually cost more because of overseas documents, equity arrangements, licenses, tax planning, banking preparation, and immigration work. These are only incorporation costs. The company must also budget for rent, deposits, equipment, accounting, payroll, insurance, licenses, employment, marketing, visa support, and working capital. Ongoing KK obligations. AKK generally holds an annual shareholders meeting, prepares financial statements, files corporate tax returns, maintains minutes and corporate records, and publishes its financial statements through the public notice method stated in its articles. It must also track director terms and register changes to its address, directors, representative director, capital, purposes, name or share structure within the required deadlines. AKK should be maintained as an active legal organization, not registered and forgotten, KK or GK, the final decision. Choose a KK when shares, outside investment, several shareholders, ownership transfers, institutional partnerships, or formal governance create real value. Choose a GK when the company will remain closely held and founder control, and simplicity, flexibility, lower setup costs, and lighter administration matter more than issuing shares. Neither structure is universally better. A badly planned KK is not stronger than a well-run GK, and the cheap GK may become inconvenient if the company later needs a complex equity round. Before incorporating, decide who will own and manage the company, whether investors will be added, what licenses and premises are required, how much operating capital is realistic, whether business manager status is needed, and whether the company can satisfy banking and ongoing compliance requirements. Those answers, not prestige, should determine the structure. If you are still deciding what kind of company to start, we also have videos covering practical business ideas for foreign founders in Japan. Those videos explain the customers, startup costs, licenses, and operating requirements behind different business models. If you are planning to establish a Kabushiki Kaisha or Godo Kaisha in Japan, SmartStart Japan can help you evaluate the structure before you commit. We assist foreign founders with incorporation planning, articles and registration documents, capital strategy, office and banking preparation, post-incorporation filings, and coordination with the business manager visa process. Book a consultation at smartstartjapan.com. We will review the business model, identify practical risks, explain the expected costs and timeline, and help determine whether a KK or GK fits what you are building. If you are still comparing company structures, watch our full video on setting up a Godo Kaisha in Japan. And if you need to live in Japan while managing the company, watch our updated Business Manager Visa video. It explains the current 2026 requirements, including the 30 million yen capital standard, employee requirement, Japanese language level, office, business plan, and realistic timeline. Both videos are linked on screen and in the description. Thank you for watching.